with life insurance, when you have the money into a permanent plan, what happens is, let's say one year the S&P 500 on average for the year, it did 10%. Okay, then you get 10%. Next year it went down and it did negative 20%. Well, that year, instead of you losing 20%, you will get 0%. So you just don't get any interest that year. But that's the big difference between having your money in something that when it goes down you lose money, than you keeping your principal and your interest, so that then the next year it hopefully goes back up, and you're not now starting from a negative 20% to get back to where you were to now go back up, right? You just stay where you were and then go up from there. So this is an interesting way of using life insurance to help supplement your retirement income. Okay, it's not to help. I'm not saying don't put your money in your 401k. I'm not saying that. I'm saying supplement some of that in a permanent plan if it's something that you can afford to do, and so forth. So it's just something, an interesting way of supplementing your retirement. You can use that for retirement, or you can use that 20 years from now to go on a trip, right? Whatever you want to do. It doesn't have a label what you need to use the money for.
Awesome.
And since it's coming from a life insurance policy, when you take the funds out of there, depending how you take it out and so forth, it is tax free.